Welcome to the Legal CFO.
Welcome to the show where clarity meets profitability. This is the Legal CFO with Ryan Kimler, the founder of Net Profit CFO. If you're a law firm owner looking to get a handle on your finances, grow your bottom line, and finally take control of your numbers, you're in the right place. Each episode, Ryan breaks down the business side of law with straightforward strategies to help your firm run smarter, earn more, and scale with confidence. I'm Heidi Mack, and today's episode is Cash Flow versus Profit, Understanding the Difference and Why It Matters. Hi, Ryan. Thanks for joining us.
Yes, absolutely excited to be here and dive into this today. So thank you for having me.
Yes, of course. So let's dive right in. Why do some profitable law firms still struggle to pay their bills?
There is a difference between what you profit on your income statement or profit and loss. Both of those, they're the same thing, right? Interchangeable. You get down to the very bottom and it says this is what your profits are, right? And you get down to the end of the year and that profit number is what you're going to pay taxes on. Now, there is still activity, business activity that takes place after the net profit number before we really get down to, well, how much money is in the bank? And so you can absolutely have, and this is a big distinction that I cover with my clients, and sometimes it is kind of hard to comprehend, so I'll try to go through and explain it, but you can have positive profits, you can pay taxes, and your bank account balance can drop and decrease year over year because of the additional transactions and business activity that happens, what we call in the accounting world as below the line activity, below the profit line, right? Mm-hmm. You can also, I'll do the reverse of that, the inverse of that, if you will. You can also run your business, have a net loss, not pay taxes, and have your bank account balance still grow. And in cases, like there's a lot of cases like people have probably heard of, I think it's Uber went like 10 years before they ever showed a profit. And people are like, wow, well, how in the world does that work, right? So let me go through a couple scenarios. And I think let's start with the first one of how could you have a net loss and then still have money coming in, right? Yeah. So your net income, net loss really is the summary number of your business operations and how efficient your business was. After that, you can bring on debt. So debt is something that's below the line, what we would call below the line activity. You could go out and get a line of credit. You could go out and raise money. That would be, bringing in debt is going to add money to your bank balance, even if you showed a net loss. So that's one of the activities that like an Uber or somebody like that could do to make it through those years where they've had a net loss. So I'll start there and end with that.
There's a lot of information here. Are you also explaining the difference between cash flow and profit? Is that
you could have a positive profit? Let's say, I'm just going to throw out round numbers. Let's say $10,000 in profits. But if over the course of the year, if you have to pay back $12,000 in debt, your bank balance is going to drop by that $2,000, right? Because those debt payments have to be covered. So there's really, I'll cover three big categories that makes our difference between profits and cash flow, profits and net cash flow. First one is really changes in your assets. Those are things that the business owns. So that includes your receivables. So if you're a law firm out there and you bill a client and you don't collect from that client, that's obviously cash that you don't have in your business, right? So that is going to make you struggle to pay your bills when you don't get that cash through the door. If you go out and you get a new office space and you're going to furnish it, right, and you're buying furniture, that would be considered an asset. And the IRS does not, like if you go out and spend, I'm just going to throw out, again, round numbers. Let's just say 25 grand on furniture. The IRS does, it's possible, right? It'd be a lot, but it's possible. The IRS does not let you deduct that furniture from out of your net profits, right? They don't let you use that major purchase to reduce what you're going to pay in taxes.
Gotcha.
So $25,000 left our bank account. We went out and bought furniture. That did not reduce what we show in profits. Those are the main things in the asset section that I'll cover that makes changes between profits and cash flow. And then we get to the other side, which is debt, right? Which I've talked about a little bit. But if you went out and got a line of credit, maybe you did some case financing, maybe you just have an operating line of credit and you use it if you go through tough times. If you have debt that you're paying back, maybe partner's car, something like that. If you have debt that you're paying back, the IRS does not allow you to deduct debt payments against your income either, right? So again, you could get in a situation where if you have low profits, like I threw out earlier, like 10 grand, but you have $12,000 in debt to pay back for the year, you're going to have less cash in the bank, even though you showed a profit and even though you're going to pay taxes. And then lastly, you get down to the equity section, which is part 3 after your debts. And that includes, well, really, it includes stock and things like that for publicly traded companies, but I won't get into that for most law firms. You're probably not. The big thing that is included in the equity section is owner distribution. So if you distribute money to yourself, there again, you're taking money out of the bank account, but you're not deducting that out of your profits. It's different from a salary. Your distributions are not deducted out of your profits. So again, right, you could profit $20,000 on the year. If you distributed 25, you would have $5,000 less in the bank than what you profited, right? And so your bank balance is going to go down, assuming there's no other activity, right?
Wow.
One thing that business owners also kind of have some confusion with at times is for all entities, unless you're a C Corp, your taxes are your personal liability. So if you take money out of your business to pay taxes for your business profits, that's a distribution. That's a draw. So again, your draw is not going to reduce your profits, but you're still going to pay taxes. So that money to pay for taxes could also come out after profits and reduce your bank balance. And some of, again, if you're not financially healthy, making good decisions around debt and what you distribute, you could definitely get yourself into a situation where you're making profits, but you're still having problems to pay your bills because you don't have the cash flow.
Wow. There's so many things that go into this.
There's a lot that goes into it.
Yeah. So out of those, because you gave so many different reasons of cash flow problems, out of those, like, what is the most common that you see for the cash flow gap?
Yeah, biggest that I see is definitely receivables, right? And billing your client and not collecting, from your clients on a regular basis, not collecting at a good rate from your clients. That for sure is the biggest one. I would say that's number 1 if I had to rank it. Number 2 is probably distributions, and that goes in with taxes, right? There's definitely a crunch when you roll around and get into April, because you've got to take, usually most business owners are not setting aside personal funds as they pay themselves throughout the year. So they've got to take funds out of their account as a distribution to pay their taxes from the prior year. And so I would say, again, receivables is number 1, distributions, and I'll kind of like a subletter to distributions, if you will, is really to cover the taxes. Those are your top 2, I would say.
Wow. So that means saying that probably plays a role with other things. What role do payment terms and collections then play in protecting the cash flow?
Yes. So billing on a regular basis and then also having payment terms is really going to help you collect at a better rate, and also really qualifying your clients at the front end, right? And making sure that they're able to pay. I think, we've talked about on the show before, having good retainers, right? And showing that your client can pay 3 months of your bill is a great kind of test point to keep your collections rates high. But then like I said, after that, I mean, billing consistently so your client knows when to expect the bill. It puts them on a schedule, especially if you have 30-day terms, right? Especially if you're working with like businesses or corporations, if you're doing legal work serving businesses, getting them on a schedule where, okay, where's our bill from XYZ law firm, right? And they expect it, right, by the first, and they know, or whatever day you get your bills out, even if it's the fifth, right?
Yeah.
They expect to have it by the fifth. And then when they're going through their accounting department, they know, okay, we've got to pay this bill. It's due date by the fifth, right? And so being really consistent and having, straight terms, again, I think 30 days is more than reasonable and pretty standard. Actually have terms. Don't just say, oh, well, it's due upon receipt, right? I think most decent people, if you do say due upon receipt, most decent people think that a 30-day time frame is reasonable. But you could have clients that push that timeline and aren't really respectable of it.
Got it. So then, how should law firms approach their cash reserves or rainy day funds after that?
Yes, love that question. So if you asked me that question a few years ago when interest rates were really, really low, I would have said each law firm should be working to build 4 to 6 months of cash in the bank of expenses. So, in other words, if sales stopped coming in the door tomorrow and no more bills got paid starting tomorrow, you would have enough to pay all of your bills for 4 to 6 months and keep the door open. Now, in today's market, I understand that for some law firms that can be a really big number, right? We could be talking about hundreds of thousands of dollars, and with a higher interest rate environment that we're in, you can invest that money in some lower risk like bonds and CDs and things like that, and get a pretty good return on those dollars versus just having them sit in a bank account and earn 1%. So, given that environment, I love to have firms build to 2 months. And then if you have additional funds that you have readily available, in T-bills or some sort of short-term investment that you could trade and get out if you needed, I think that that's great. But having a good reserve, again, of at least 2 months, I think gives owners peace of mind, helps them sleep at night, and really puts them in a place where if you do have a down month or something happens, something changes in the economy, it gives you time to make pivots and make changes and really make sure that your business survives and does well.
Nice, nice. So then, in your opinion, to help monitor with that, what tech or reports could help firms monitor and forecast their cash flow?
Forecasting forward and looking at where is my business headed, super, super important, right? At the bare basics, most likely you're probably in QuickBooks or some sort of accounting software. There are a lot of plugins that work with QuickBooks, but at a minimum, you can just use Excel. Excel has an automatic forecast function that you could forecast your finances forward. So at bare basics, you could use Excel. If you wanted something more than that, there are some softwares and some tools out there. I think there's like Spotlight, Fathom, Float is another one. There's a few different software tools that make it pretty easy to forecast your cash flow based off of your financials. I think that's a really, really important tool that if you're not leveraging and utilizing that in your law firm, you should be. And really, really important, because if you're going to have a cash, a point where cash is tight or you're going to get into a crunch, the sooner that you know it and the sooner that you can then make pivots, the better off you're going to be.
Yeah, out of all those ones you said, I'm used to QuickBooks. I like that one. You can put everything in it, like your receipts, gas, I mean everything. I mean it's so user friendly.
For
So
sure.
yeah, I mean like you said, at the minimum, that's one of them for sure. I can attest.
Yes. Yes, absolutely.
Sure. So moving on from there, how do seasonal trends then or case types impact cash flow planning?
Yeah, absolutely. I think it's important if you're in some sort of industry where you are seasonal, right? Definitely be looking at your historical trends, right? And be prepared for it. If you know that fourth quarter is slow because we run into holidays, right? Definitely be prepared for that. And my general rule of thumb of, oh, you want to have 2 months of expenses in the bank, you might need to have more than that and be prepared for it. But I really like looking at the last 2 or 3 years of, well, what have we done historically? One of the best exercises I think you can do is take your profit and loss that has all your revenues by month. So you've got 12 months there, like if you were looking at 2024, and then, just do some division and say, okay, if I did $10,000, I'm just going to, again, round easy numbers, $10,000 of revenue in July of 2024. And in total, my business for the year did $120,000 in revenue. Obviously we know, that would be 10% or whatever, right? Do the division, figure out, well, for each month, how much of a percentage am I contributing to my annual revenue, right? And then really look at this year and try to match up those percentages when you're doing a forecast, right? So if maybe July is 10% of your revenue or 12%, whatever, and you can look forward to December and December is only 7. Well, you can do some math and figure out, well, right now this year, I'm projected to do X dollars in December based on those percentages. So kind of doing a little bit of historical analysis and a little bit of division, get down to a percentage.
We all love math.
Yeah. Use Excel. It does the heavy lifting for you. Or you can do it in some softwares, things like that. And your bookkeeper accountant might be able to help you out with that. But obviously working with a firm like ours, having a part-time CFO can definitely help you with those kind of calculations and looking at that.
Wonderful, wonderful. Well, something's up for this episode. What's one small change any law firm can make today to improve cash flow?
Yes. Where do I start? One small change. It's hard to narrow it down to one, but I will try. I would say the one small thing, again, I think the biggest thing is AR for most firms and how they're collecting. And so one small change you can make there is just put in the procedures, put in place so that you're billing consistently, you have the terms. That's probably the easiest thing that you can do. And then really hold yourself accountable to it, right? Doing that is only going to have cash flow coming in the door more consistently, which is going to help you sleep better at night, have a stronger business. And so if I had to say one small thing, I would say put in your billing procedures, really stick to them, hold yourself accountable, be disciplined about it.
Yes. Organization is key.
Yes.
All right. Well, thanks for listening to the Legal CFO with Ryan Kimler. If you're ready to get financial clarity for your law firm, visit netprofitcfo.com. And don't forget to like, follow, and leave a review, because the more you know, the more you grow. Thank you so much, Ryan.
Yes. Thank you for having me.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.